Well, good afternoon and welcome to today's Brown Bag webinar. Before I introduce today's speaker, I just want to go over a few housekeeping items. Everyone on this call will be muted throughout today's presentation to avoid disruptions to our speaker. If you would like to ask a question, please type it into the chat box at the bottom of your screen, and our presenter will answer them as he sees fit. Today's speaker is Don McHugh. As a licensed financial planner and mortgage banker for 23 years, and with 29 years of business management and sales experience, offers an unprecedented level of insight and advice into each borrower's mortgage choices and the effect on their overall financial planning. Don is a 19-year NAIFA member and is currently NAIFA Greater Foothills' president. Don can work with families and business owners on reverse mortgages, conventional purchases for a new home, refinances, loan modifications, credit analysis, BK, foreclosure, and divorce strategies. Don, please take it away.
Thank you, Jesse. I appreciate the opportunity to represent on some level NAIFA. As you mentioned, I'm currently president of the Greater Foothills chapter, and I'm going to be terming out in June. So it's been a lot of fun for many years. I've gone to Sacramento and Washington, D.C., shaking hands and advocating for NAIFA. I started out in 1996 as a licensed life and health guy, then got my 6.3, my LETCF, and began my CFP. And like all of us, we have to find the money to help our clients and to build our business. So I was doing the classic, let's refinance your house and get it down from 8 to 7%, free up $350, and we'll reallocate that over to a strategy that's going to benefit you and not the bank. Well, typically that's refinance cycle lasts 3 or 4 years. As we know, that last one lasted about 8 or 9 years, and we're still in an extremely low interest rate environment. And as a result, for a long time, nobody wanted to talk about the 401k that was earning 3 or 4% taxable. They wanted to talk about real estate that was earning 20%. And I had a broker I was working with, and I'm shoving the loans to him and get him to do them. He's overwhelmed, and nobody wants to ask staff because they're concerned that the bottom's going to drop out. As it is now, we see lots of mortgage lenders across the United States closing doors in rapid fashion. So I got good at doing mortgages because I needed to get those things processed and closed. And at some point it became, I made a lot of money, made good money. Then I didn't make so much money. Some people thought I stayed stuck, I'm stupid. But I made a decision to morph into the mortgage industry full time. So now I call myself a recovering financial planner, but I do pay my dues for NAIFA, and I advocate for the best industry in the world, which is the insurance industry. It's the backbone of America. So I try to hold myself up as a little bit of a resource to talk about all things real estate finance concerned. We're currently going to be highlighting the reverse mortgage, but I don't just help with the reverse mortgage. Any of the mortgage options that are out there, whether they're some of the new self-employed, no tax returns, whether they're hard money, whether they're conventional, VA, FHA, or jumbos, we can weave all those in to really give your clients an option that will be best suited for them. And obviously that's going to be contingent on your input because we're going to partner together. So the classic advisor options that we all would understand is, I don't like reverse mortgages, and then I'll get to ask why, or it's the last resort only, or it's time to do one right now. So we're going to just highlight some myths and misconceptions. We're going to highlight a few sales strategies, and we're going to get out of here. So we all know that retirement assets are in 401ks and home equity and IRAs. There's lots of money out there, and we're all looking at the fact that people are turning 65 every day, and there's lots of people that don't have retirement income, and there's a huge need for long-term care, and we have rising nursing and home health care costs, and people are having a real struggle about how to pay for them. So HECM, HECM, that's what you hear most of the time. It's a reverse mortgage or it's a HECM, home equity conversion mortgage. So we're going to seek to get our clients approved and to have them qualify for a home equity conversion mortgage, meaning they have to have some home equity to convert. So you can't come to me with a person that's 80 or 90% LTV, loan balance versus the appraisal value today is not going to work. So at the end of the day, a reverse mortgage is an equity line. And a rule of thumb, roughly, if they don't have about 50% equity, we're probably not going to get a deal because the payout has been lowered significantly over the years. Why? Because people are living too long, and just like long-term care insurance, the ability for actuaries to price this thing right isn't happening. And so what do? We raise the price or we lower the benefit. So we've had a reduction in payouts, so people that used to qualify don't. That's where we come in and create strategies, and we can talk about those later. So let's see, next slide here. Misconceptions. A reverse mortgage are only for the desperate seniors. The reality is even the seemingly wealthy can be, and many are, house rich, but cash flow poor. We know people sitting in million-dollar homes easily. One of the spouses is ill. They're looking for help to continue to live in that home. And if we can do a reverse mortgage and structure it properly, they can live in that home for the rest of their life and pay property taxes and insurance. The other misconception is that the home must be debt-free to qualify. Absolutely not. This is a refinance. So we get a new reverse mortgage that pays off the existing mortgage that has a mortgage payment. The current mortgage goes away and the mortgage payment goes away. So what we try to improve is, at least at a minimum, cash flow to get rid of that current debt. The other things I hear are that the bank's going to own my house. Really? Do you have a mortgage now? Who owns it? Not the bank. If you look on title, you're on title. The bank has a lien against that title. They're a partner with you. And as long as you play by the rules of the contract, the lender has no rights. If you don't play by the rules, they can go to court, secure title through foreclosure, get their share of what is in the loan, and then the rest goes to the heirs or the owner of the house. And that's for every mortgage. A mortgage is a mortgage is a mortgage. There's nothing different about this reverse mortgage. We qualify them the same way. We secure financial information, we look at the credit, and we look at their overall lien positions if they have clear title to the house. So the bank will not own my house. So that means the kids will get my house if that's what you want to be happen ultimately if you sell it or if you pass away. Obviously, a house should be in a trust to allow for smooth transition. And the other thing we hear a lot about is they're expensive. This is an FHA loan. It has mortgage insurance. It's going to be about 2% of the loan. So it's the cost of doing business. There are no options for that at this time. We have had proprietary loans in the past. Some more are coming on the market from time to time. But right now, I just discussed a HECM is a home equity conversion. So it is non-recourse. If the house would become lower and lower and lower in value, and the mortgage would go up and up and up. See, the reverse of a reverse mortgage is one thing. We pay our conventional mortgage and the balance goes down. The agreement on a reverse mortgage is we don't pay it today, so they add it to the balance today, so the balance goes up. That's the difference. Everything else is the same. At the end of the day, could we conceivably have someone that lives 25, 30 years with a reverse mortgage, and that mortgage loan could go way up, and at the same time we have a drop in home values, and the balance is higher than the value of the house? Yes, this has happened once or twice in history. So it's a non-recourse loan. It's a standalone conversation, just like an annuity. Win or lose based on the contract. If the contract is upside down, the borrower walks away from the house, it can give the keys to the borrower, the lender in lieu of, and that's it. There's no recourse. They can hit the lottery, own property, cars, art. The lender can't touch it. So the house goes to the children. It's non-recourse against the children. So it's just a win or lose based on the contract for the property. Let's get. All borrowers must be 62. They must be U.S. citizens or legal residents. We discussed these HECMs are FHA insured, hence the FHA insurance cost, which people can balk at, but we don't have an option. It's for primary residents only. The property must be owner occupied. We had a recent increase of the maximum loan amount, $726,525. We use that or the appraisal value, whichever is lower. So we got somebody that has a home that is worth $726,500 and $1 million. Side by side, everything else being the same, both borrowers will only be able to go off of the 726 loan amount. And then it's like an annuity, it's based off of the attained age. Older you are, the more you get. All borrowers must receive a counseling session. It's a phone call, and it's really pretty much a no-brainer, but it's in there to keep good borrowers protected from bad guys like me. So it was instituted a few years ago, and we know they're trying to legislate morality. It's all good with me. So you get started. Okay, we talked about that. Mortgage insurance premium, we talked about that. Principal limit factors, again, is based on the appraisal value or the maximum lending limit, whichever is greater. So the person that has a home over $1 million, over 726, doesn't get any more money than a person at 726. Except now we do have some jumbo products, which I'll highlight a little bit. They go up to a $4 million loan amount, and it's a terrific loan concept for some folks, given that we're living in California. And the reverse mortgage can be a refinance, which is a classic conversation we've had historically. It's also a purchase loan. So the same person that lives in that $1 million house with a $350,000 mortgage has a nice equity position. They can sell the house, take those net proceeds. Typically, they'll go and they'll pay cash for the new house because they want no payment. We can come in as advisors and explain to them, let's get that new $500,000 house that you're going to pay cash for the one benefit of no payment. And we're going to get that house through a reverse mortgage loan approval process. And let's say roughly 50% of that $500,000 purchase will be your cash that you bring to the table instead of 100% cash, half cash, and the rest of it will be funded by the reverse mortgage purchase loan approval that goes right into the escrow. So you get the house you want, reverse mortgage loan, no payment, cash purchase, no payment, reverse mortgage loan, half the cash in the bank, liquid, to allow their financial advisor to secure and enhance the retirement planning. It's a great concept. Okay, counseling is a phone call, as I discussed, pretty easy. We can walk through that at some other point. Property, we talked about new and existing single family homes. We can even do new construction. It can be up to 4 units. So you can buy or do a reverse on a 4-unit if the borrower is living in one of the units, primary residence. And we also can do FHA approved condominium. That's been a real eyesore. A real snag recently because so many condominium complexes let their FHA approval go. Manufactured homes as well. We can even do coaches if they are on land that they own. Okay, let's see, vesting. We can do it for a single borrower, a couple, and it can be in a trust. It's not a problem if it's in a trust. The trust has to be reviewed by the lender and they're legal beagles and is subject to approval of the trust. If we have a real problem with that, we can take it out of the trust and fund it that way, and then give the borrower the opportunity to get their trust together later. Obviously, competency is a big deal with a lot of these folks. Having a solid power of attorney written correctly for financial and health is imperative. History real quick, 1961, the first reverse mortgage was done, which I say, okay. And I started doing it in about 1999. I've seen the good and the bad and the ugly. But at the end of the day, I think it's a win-win for most borrowers. You know, the only downside is, well, the house won't be a legacy for inheritance by the heirs. And we understand that. It's a very emotional time for some borrowers. At the end of the day, me and Hein, we're talking to them about compelling need. And the choice is obvious. They're going to do it. So one thing we're going to talk about is, 1987, it got revamped through Congress, became a little bit more of a secure product, a little bit less of the equity share conversation that we heard about on occasion. HELOC versus a home, a HELOC versus a HECM. The HELOC, you can go get cash, just like the HECM line of credit, and you have to make monthly payments on everything you use. With a HECM, no monthly payments are required. Anything that you have as a remaining balance in the conventional HELOC sits there available for you to use if and when, like a credit card. You don't owe it unless you borrow it on the conventional HELOC or on the HECM line of credit. However, unused balance for the line of credit with the reverse mortgage is growing. Let's say, for conversation, roughly 5%. This is a variable loan rate. It goes up and down with the LIBOR, but that money sitting there unused is growing at a growth rate, giving the borrower more money. Maturity on the HECM is lifetime, and typically on the HELOC is about 10 to 20 years. A HELOC can be canceled, and we know that a lot of us got our equity lines frozen and canceled years ago with all the insanity that went on with the mortgage industry. On the HECM, the loan draws cannot be frozen for any reason except, and I made a note there, if there's a fire or earthquake and your property is in that area, they're going to be checking as a partner in this property on the overall structural integrity of that property. And if there's damage to the house, they can tell you, they can ask you, what are your intentions? And if your intentions are stated, I'm not doing nothing, they do have the right to freeze any remaining equity in the equity line if it hasn't been used, obviously, to protect their position. That's fair. There is no prepayment penalty on the reverse mortgage. There are no annual fees once the loan is opened, and we're gonna move on here. So this is a classic scenario. Home value $495. There's nothing to be paid off on an existing mortgage, but a reminder: the house does not have to be paid off to do a reverse mortgage. It just simply means that there's less remaining money for the borrower after the mortgage is paid off. We're going to get an appraisal and we're going to have an age. Those two factors are going to determine a set amount of money. There is no negotiation on how much money is going to be approved for. Once that money is approved, it is available to sit in the line of credit. It's available for monthly payments. It's available for, let's say I want $500 a month. Any payout option that an annuity has, we can mimic with the reverse mortgage. Unlike an annuity, it's not etched in stone. It can be changed at will. Okay, let's see. Outstanding balance in year 20. That's the balance for the loan if they didn't take any money out and they just had the initial closing costs, which are typically rolled into the loan because nobody pays out of pocket. The line of credit sitting there, unused, you can see is growing each year. And that money, by the way, is tax-free. We can also see the home value is growing continuously. These are all assumptions. However, it's a good illustration to show you what can happen. And then the net equity has obviously grown as well because the home value has grown and the line of credit is growing, and that money is available for the borrower to use at their discretion. Obviously, we're also thinking about our book of clients and who might run out of money and what their life expectancy is, and will they have enough money to retire on, and can this hedge their security for their retirement? Absolutely can. So one of the strategies we're going to overview real quick is the sequence of returns. And we understand that the average for the stock market, let's say, is 11%, but that's an average. And contingent on what year the negatives happen and what year the major growth happens. When we're in the accumulation stage, it doesn't matter. But once we're in the distribution stage, it can matter significantly because a borrower can run out of money. With all the assumptions that were in place, they can't all come to fruition. So using conventional wisdom, we can look at a home equity via the reverse mortgage as something that can supplement retirement income. And the way that works is, unlike the consideration for the HECM as last resort, we can actually have a coordinated strategy where we can look at trying to access this equity today and have it sitting in place when it's needed. Okay, 50% of workers with household income of 75,000. Savings, they'll need about 70%, and about 41% of the workers know that they need to retire, need to save more money in order to retire. So here's a real rough scenario. We see the portfolio performance, and there's 3 negative years there, and contingent on the money they're taking out every year, and when those negative years occur, it can substantially reduce the overall portfolio performance, and we can run out of money. And of course, your assets under management are gone away as well. So in that scenario, the portfolio was exhausted in 24 years, the portfolio value is 0, and the total amount of fees collected by the advisor were about $66,000. So if we go to another scenario, the same scenario in the beginning, however, we took out an equity line, and the equity line is sitting there available for a tax-free distribution to supplement the retirement income on the years the stock market is down. That means you're not pulling money out of and reducing the portfolio balance in the years when the market performance is already down. That allows for that money that would have been taken out to remain in the portfolio. And in that scenario, we can see that the result was the portfolio value continued to climb because we didn't have negative years. The assets under management remained higher, and the fees collected by the advisor were higher. Because we have an asset that is tax-free and we can access it on the years that we need to, that allows for less reduction of the principal of your investments. Let's see here. We do have a a jumbo product, which is coming into more and more use, obviously because of the huge appraisal values of homes in California. A 726 appraisal value isn't going to get anybody any money. So we look at ways where we can leverage these new proprietary loans. They have all the same restrictions and requirements for approval that the conventional HECM that we're familiar with does. So let's see here. 82-year-old guy owns a $2 million house, San Diego, has other investment properties, ready to retire, is attempting to accomplish two things. He wants to get rid of his $250,000 mortgage on his primary residence so he can get rid of that mortgage payment, which will then improve his cash flow. And at the same time, he would like to convert some of his equity in his home. Now, in this conversation, we have compliance and different broker dealers, et cetera. So we're not going to get into what can be done with lump sums of money. But at some point, it's obviously available to secure someone's financial well-being in a manner that would be much improved over not having access to that cash. I want to go over here, and the bottom line is right now we're enjoying very high equity positions. One of the strategies that we're working with is, I don't care if it's 62 or 82, get a reverse mortgage, grab that equity, drop it into the line of credit, and let it sit there, earning, let's say, it's a variable rate, 4.825, 5.125, is going to be earning a nice rate of return. We can't call it interest because it's not classically interest. It's a growth rate. It becomes part of the line of credit available for use by the borrower. If they die, it reverts back into the equity position of the home. But what we're doing is we're locking it in today, because if we have a drop in home values, that equity position is going to be reduced. So why not lock it in today? So let's say they're 62, they're still working, they're still making their mortgage payment, their cash flow is good, they're not having the challenge today. We can do that line of credit today, lock it in. They can continue to make a monthly payment on the reverse mortgage. So that means the balance of the reverse mortgage is not going up, but the line of credit they got is going up. And then, of course, the market value is going to be subject to whatever the market does, but we've locked in that equity. So continue to pay the monthly mortgage on the balance, maintaining the equity position until they choose to stop. So let's say 72, they've had 10 years of having the equity position growing at, let's say, 5% tax-free compounded annually. The market value on the house has dropped, but they secured that line of credit contractually. It is theirs. It cannot be touched because of any fluctuation in market values. There's a contract that is a snapshot in time, and they were awarded that much money. That is their money forever. They can spend it all and still have the privilege of living in their home, or they can let it grow and use it as they need to. Obviously, taking systematic payments or taking a lump sum here and there, all those are options for them. So when I got in this industry, the reverse mortgage was a verboten conversation, and you could get lots of trouble. And the apps all said, are you using this money with an advisor, et cetera, et cetera. What's happened is many of the leading academic and industry institutions have now embraced reverse mortgages to the point where FINRA reversed their position in 2014 as a reverse mortgage being only a function of a last resort. Does that still mean that we do things with integrity and with a risk tolerance conversation? Absolutely. However, I was in San Antonio. We had an attorney from the American Academy, the American College, specifically addressing reverse mortgages. And much like long-term care insurance, is suggested by the DOL, best interest of care standards, to have a cursory knowledge of reverse mortgages, just like long-term care, as an advisor, and to make sure that you're sharing that information with your clients. My comment here is whether wrong or bad information or wrong information is potentially exposing you to somebody wanting to sue you because you didn't tell their loved ones about a reverse mortgage. So my suggestion is it's prudent to document your files that you discussed this, just like the long-term care, and that they declined it, and document it to protect you. Bottom line is clients are asking about these every day, and for you to have at least some knowledge about this and to bring this up and have it on the table, in my experience, will protect you from having your relationship being referred away to the guy that's talking about the reverse mortgage, who then has their preferred financial advisor that they work with. So it's kind of important that you bring it up. You have a good resource to ask questions, to run scenarios. I'm a independent mortgage broker. I've done the direct lender. I've done the credit unions. I've done the savings and loans. I've done it all. They were all valuable experiences, but now I like the ability to be appointed with a half dozen lenders, and to, when I talk to their AEs and their underwriters, they know that I have the ability to move my book of business elsewhere if I'm not going to be getting favorable responses and timely information. So it's the best of all worlds for me. And I think that's about it. Do we have any questions?
I don't see anything coming through. If you guys do have any questions, again, please put them in the chat box or the Q&A box.
That was a real fast deal. The bottom line is, with reverse mortgages, you own the house. You can live in it for the rest of your life and pay tax and insurance. So people say, "Oh, I'm going to sell my house and go rent." Okay, well, where are you going to put that money where it's safe? Where are you going to put the money from the sale of the house that is safe and making more than 5% with no market risk and tax-free? You're not. So you move into an apartment and you live there the next 20 years, and you're subject to rental increases every year. Whereas if you stay in your home with a reverse mortgage, you can stay in the home that you love, stay near your church, your family, your school, your doctors, typically your family, and you'll pay property taxes and insurance. So what is that? 500, 600, 800, 1,000? Call it whatever you want. You can't rent a room in the back of somebody's house for that much money anymore. So it's really a nice opportunity for a lot of people to consider. And we walk through this with your clients and with you. We brainstorm together. We address each person's risk tolerance and their fears and their family dynamics and their financial realities and their short-term and long-term views. I mean, you can get a reverse mortgage, 6 months later decide to move to Florida, sell the property, and pay off the existing mortgage balance, and the rest of it is yours. So there's no prepayment penalties.
It looks like we do have a couple questions, Don.
Okay.
The first one is, if a homeowner is 55 and permanently disabled, the home is paid in full, is there an exception for the age 62?
No, unfortunately, there are no exceptions at this time for disabilities I know we have a veteran population out there that we would like to be able to serve. At this point, there's not much on the table for that. Historically, you had to be 62 to do a reverse mortgage. So we would have someone that was in a financial bind. They were compelled to consider the reverse mortgage. And let's say the primary borrower, the male, typically was 62 and the spouse is 56. The only option we had was to take the spouse, the younger spouse, off of the property, do the reverse mortgage only in the 62-year-old person's name. And then the result was we had to have a situation where the spouses trusted each other. Typically, I would advise that they put the property in a trust, and when the primary borrower died, the trust would make the spouse the new owner, and then they would own the home. The problem was, let's say that 62-year-old borrower that now was 82, and the young spouse was now 76. Well, she's going to lose the income from the spouse when he dies. The property value will be whatever it is, but our loan balance on the reverse mortgage has gone up for 20 years. So the only option was for the non-borrowing spouse to find a way to get a new conventional mortgage or a reverse mortgage and pay off the existing mortgage. And 99% of the time, it didn't happen. It did not happen. So the spouse was forced to sell the house and move on. So after a lot of outcry over the years, the reverse mortgage industry not wanting their image to be tarnished in any manner said, fine, we will make a reverse mortgage loan for an underage couple, or if one couple is underage and the other one is overage. However, again, because it's based on attained age, like an annuity of the youngest borrower, they would get less money. So we can do it if one borrower is under 62, if the other borrower is 62 and they're legally married. We can't have, I can do reverse mortgages for daughters that are 62 and mothers that are 82, and they'll both be on the property title. And that's a great way to allow that property to transition to the youngest, to the young daughter with no problem. But if they're under 62, only if they're married. I hope that answers the question a little bit.
All right. The next question is, the annuity application still asks the question regarding reverse mortgage funds being used. Do they still frown upon it?
Well, I mean, that's going to, some broker dealers will frown on it. That's going to be a personal call. My disclaimer is I don't know what your situation is. I just know that I've seen lump sums of equity used elsewhere for maybe products that have multiple benefits versus the one benefit. You know, I had a JPL engineer that was absolutely insistent on taking his equity out of the house and putting it into some kind of investment because he was concerned about earthquakes and he didn't want to deal with having to rebuild it. So the question is still there. Yes, I don't think it will go away. But I don't think it's a deal killer. So I would say talk to your broker dealer and go with whatever that conversation results in.
All right. Another question I have here is just asking whether or not your slides can be available to the attendees.
Absolutely. Yeah, please call me or send me an email. My information is at the end here. And I'll leave it on the screen for a while so you can copy it down.
All right, that's all the questions I see coming in. We'll leave it open for a couple more minutes here while people are taking down your information here, Don, and see if anyone else has any more questions.
Yeah, I'm just trying to look at my notes here. Bottom line is the reverse mortgage doesn't work for everybody, but with the line of credit, it's a huge option to lock in some equity. And I know a lot of people are rushing to do this right now because if we have equity positions dropping, that's just money that may not come back in their lifetime. If we can lock it in, they can continue to make their payment today. And then when they decide if they don't want to make a payment anymore, they can still be in the reverse mortgage and have a line of credit that grew over the last 10 years. I do have one illustration that I couldn't get into this PowerPoint, so if someone wants to see that, I can illustrate it where the mortgage balance on the reverse mortgage stays flat, and then we have some assumptions on the market growth and some assumptions on the line of credit, but obviously they illustrate very well. It's a powerful tool for a lot of people, and it allows for investable assets to stay invested longer, and at some point to marry income out of the taxable products with the money from the non-taxable reverse mortgage. It allows the client to secure the income they need to create less of a taxable event on the income that they're pulling out of the taxable products, and to allow more of the money to remain invested in the market, hopefully to grow longer and to enhance the security of their overall well-being. So.
Well, I don't see any other questions coming through, so I just want to thank everyone for attending today, and thank you, Don, for taking time out of your day today to do this presentation for NAIFA California.
Thanks for the opportunity, Justy. I welcome anyone's calls. My cell phone is right here and my email as well. Thank you for the opportunity.
Thanks, everyone. Have a good rest of your day.
Bye now.